I think we're at the stage right now that copper and silver are catching up to gold and beta. Copper made that new high. Looks like it was a bit dicey and probably more short term than long term. Silver's catching up, but the biggest risk, I think, to me, the more industrial metals, which includes silver now, copper and base metals, is what's happening in China. You see that from Chinese bond yields, they're declining. I've mentioned that before. And the thing about gold is it's still marching higher because who's the best buyer? China, central banks. Yet we still have had kind of flatline, somewhat stabilization of gold ETFs. At some point, that's selling. At some point, those gold ETF outflows should switch to inflows. And I think it's going to take a little backup in beta. And that's the key thing I'm worried about for second half of this year.
MikeMcGlone, senior macro strategist for Bloomberg Intelligence, observes that gold continues to rise, supported significantly by central bank purchases, especially from China. He notes that stabilization in gold ETFs could further bolster this upward trend. Unlike silver and copper, which are more influenced by industrial demand, gold's appeal as a safe haven asset makes it less susceptible to the same economic pressures. Gold has recently rebounded, trading in the $2,340 on Thursday. This increase is attributed to a weaker US dollar following the second estimate of US GDP data, which was revised downward due to reduced consumer spending. The annualized US GDP growth for Q1 was adjusted to 1.3%, from an initial estimate of 1.6%, falling below Q4's 3.4%, but matching analysts' expectations. This revision led to a decline in US Treasury yields, positively impacting gold prices. McGlone highlights that with inflation above target and a robust stock market, the Federal Reserve will unlikely ease monetary policy soon. This scenario supports gold as a hedge against inflation, but poses risks for more economically sensitive metals like silver and copper. On Friday, gold prices eased as investors digested a U.S. inflation report, essentially in line with estimates. Despite this, expectations that the Federal Reserve will cut interest rates later this year kept bullion on track for its fourth consecutive monthly gain. McGlone also points out that China is experiencing significant deflationary forces, as evidenced by declining bond yields. This suggests weaker economic conditions, which can negatively impact the demand for industrial metals such as copper and silver. In response to these conditions, China has intensified its efforts to combat investor speculation on an extended rally in government bonds, hinting that the central bank may sell some of its holdings to cool the market. Join us as we delve into MikeMcGlone's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
It's the most enduring commodity I think will continue appreciating this year, particularly when we have a little bit of backup and back and fill in beta. And I didn't say if, that's usually a matter of time. I think we're at the stage right now that copper and silver are catching up to gold and beta. Copper made that new high. Looks like it was a bit dicey and probably more short term than long term. Silver's catching up, but the biggest risk, I think, to me, the more industrial metals, which includes silver now, copper and base metals, is what's happening in China. You see that from Chinese bond yields, they're declining. I've mentioned that before. It's one of the good indicators of severe deflationary forces versus what they say. Watch what they do, watch what the markets do. And the thing about gold is it's still marching higher because who's the best buyer? China, central banks. Yet we still have had kind of flatline, somewhat stabilization of gold ETFs. At some point, that's selling. At some point, those gold ETF outflows should switch to inflows. And I think it's going to take a little backup in beta. And that's the key thing I'm worried about for second half of this year. As we look at the VIX volatility index, it's extremely low.
Wow.
If you subtract out the T-bill rate, which are key things that should be your indications whether you should be overweight or underweight the stock market, it's the lowest since 2007. That was a signal that worked really well for me back then. And you have this almost unstoppable stock market rally that makes me realize, okay, copper's catching up. That's great.
Right.
Silver's caught up. That's great. But did they catch up to something that's going to revert eventually? It will. It's just a question of when. And that to me is the macro big picture. And it's these things that you remember back from 1999 and 2007 that are just excessive speculation in equities, getting a little bit out of hand. It's a question of what spark it takes to revert. So I like to use the lessons of Jeff Booth, and that is rapidly advancing technology. Now, Jeff Booth wrote the book, The Price of Tomorrow, is very much favorable to Bitcoin, very much negative on China. He's been right. I like to point out in that space is BYD is doing to Tesla what Huawei is doing to Apple in terms of rapidly advancing technology. Now that's the macro big picture,
Right.
and I have to go to China because when you talk commodities and certainly when you talk metals, there's pretty significant deflationary forces coming out of China, and bond yields are showing that in China. They're 2.3% 10-year note is 200 basis points less than the U.S. So how long and how far Nvidia can go and last, I don't know. But here's the key fact I'll point out of my view is the U.S. stock market as a percentage of GDP is about 2 times now market capitalization,
Right.
55 trillion or so. That's the most since the 1930s. So it's silly not to expect that to matter most of everything. So if stock market goes up, inflation remains sticky, wealth effect remains strong. Stock market goes down, it's the opposite. And so that to me leads me to believe as that the Federal Reserve will not ease until stock market goes down because we have inflation above their targets, sticky, and on a one-year basis right now, S&P 500 is up about 30%. That's a silly environment to expect easing from a Fed that's focused on curtailing inflation, which they help create. So to me, that all those dangling carrots of that easing is going to leave the market. That's partly what's helped bidding risk assets like copper and silver. Silver is much more of a risk asset now than gold. And at some point, that to me is, I'll end with this. The key thing is, I think I've mentioned before in the program, is we know the pendulum swung way too far towards recession last year.
Right.
Swung way too far towards no recession this year. I think it's just going to swing back a little bit towards the middle and means recession. Eventually, we're going to get one, particularly when I'll end with the key things I'm seeing in commodities. We have deflation and we have recessionary downward trajectories in demand for diesel in this country,
Right.
downward demand for unleaded gas in this country, and for container boards, corrugated boxes, are all in recessionary trajectories that were very similar to the last ones around 2008.
Economist MikeMcGlone notes that the stock market's rise contributes to persistent inflation, which makes the Federal Reserve hesitant to ease monetary policy. This hesitation stems from easing, which could counteract the Fed's efforts to control inflation. According to government data published on Friday, the U.S. Federal Reserve's preferred measure of inflation remained unchanged in April. Despite elevated services prices, the Fed is likely to keep interest rates high throughout the summer. This approach balances the central bank's desire to begin easing monetary policy with the need to reduce inflation towards its long-term target of 2%. On Friday, U.S. stocks rose, returning from Wall Street's worst day since April. The S&P 500 gained 36.88 points, or 0.7%, to 5,304.72, reclaiming all its losses from the previous 2 days. McGlone suggests that a market correction could shift investor behavior from outflows to inflows in gold ETFs as investors seek safe haven assets. This shift could boost gold prices, highlighting the ongoing interplay between stock market performance, inflation trends, and investor strategies in response to economic conditions. Let's get back to the interview.
I don't think the Fed cuts rates until the stock market goes down and tells them to, because of what I said
Right.
earlier. The highest market valuation to GDP in our lifetimes. And then, of course, we have things like the stock market versus every other stock in the world, the MSCI XUS, the highest in our database, and only by almost 50 years. So the problem is higher stock markets right now, the rise in U.S. stock market right now is keeping inflation sticky and keeping the Fed off the table, yet the market's priced for easing. So to me, the risk is the Fed will not ease until that happens, and they shouldn't. It'd be silly. And the fact is that interest rates went up on that elevator, and I think they're more likely to go down reluctantly on an escalator, which is the enduring bear market we need to reset things. We haven't had a decent bear market since the bottom to 2009.
Right.
Every single time it drops 20% and 25%, the Fed saves us. So to me, that's what's going to happen. It's overdue, and it's just time. It's a classic end of a cycle, and I like to put it this way. Let's look back from this from the future. We just had the longest period of zero interest rates in history. It got risk assets really well bid. That's supposed to happen.
Yeah.
We haven't reverted yet. And part of the reason we haven't reverted yet is we still have that wealth effect, and we have the most significant amount of fiscal deficit spending ever outside of a war or recession. And it's still the residual effects of these 100-year events, the massive money pump. So to me, it's a matter of time for just some normalization. But that's what I think is going to happen. I think U.S. bond yields will follow the rest of the world. So
Right.
China is like 2.3%. Germany's just in the three handle. Greece is in the three handle.
What's Japan
Um,
at?
Japan is 0.8. It doesn't even have a handle. So that's the thing about Japan. It's just it hasn't handled. And I started trading JGBs in the 90s,
Wow.
Ivan, and I remember everybody was bearish, and we're gonna, brights are gonna go back up, and that was wrong. So Japan is actually it does. It's 1%
Right.
right now in the 10-year note. So that's been a while we've had a handle. So bank collapses and stock market record highs is typically an oxymoron. It
Right.
almost always happens. You almost need that lower tide, which is what happened when we had those last bank collapses last year.
Right.
Tide needs to go out and find out who's wearing clothes. And so but that's one of the number one purposes of the Fed is to come in and help when things get out of hand, like bank collapses, and help
Yeah.
keep the system from getting disorderly and be the banker of last resort. So the scenario I think is more likely is we have some normal reversion of very expensive risk assets, and we do get to that normal cycle in history that shows when you have massive pumps in liquidity and get inflation in the back of that. And when you dump that liquidity, you almost get deflation to follow because the base is so high for inflation.
Right.
Just a
Right.
matter of time it trickles down. So the Fed knows that, but the key thing is they're stuck right now, and partly because they helped boost this market. I think the Fed pivot last fall was way too early when
Yeah.
he warned he'd be easing. And the market just is what markets do. And type A impatient people, oh, I was priced for 6 eases. Now we're priced for like 2 eases. And I've been pointing out since the beginning of 23, Fed fund futures have started pricing for 100 basis points of cuts in 1 year. And it was 2023 that they raised 100 basis points after they were still priced for cuts.
Wow.
So that to me is where the market is. It's one of those unique places in history, and you just have to go back all your lessons. And the bottom line for me is risk assets in the U.S. are about the most expensive since the 1930s in terms of stock market. That's all that matters to me.
Yeah.
And then I tilt over the commodities. I see deflationary trends in natural gas, in crude oil, in corn, in all the demand metrics I point out from a commodity standpoint. And then we have things like the yield curve that's still inverted.
Right.
We have things like leading indicator that's still negative. But those things are not going to matter until the stock market goes down, makes everybody shift their attention over to that, and it'll matter. And that's what I think finally bids gold up because it'll shift those outflows in ETFs to inflows.
Absolutely.
And there's no risks in making predictions like that.
Central bank purchases, particularly from China, significantly support the rise in gold prices. How do you see the role of central banks in shaping the global gold market in the long term? What potential implications could this have for individual investors and national economies? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.